Hey, what's up, my friend? So in today's episode, I want to talk about five trading habits that keep you poor without you realizing it. Shh, don't tell anybody. So habit number one is this: chasing the markets, right? You open up your charts and you see the candle boom, right? Wow, so huge, so bullish, right? It's time to enter the trade, right? To capture that little bit of momentum because I know the market is going higher. I'm just going to exit the trade right quickly and book some quick profits. So you chase the market, but the moment you hit the buy button, somehow the market is watching you, right? It knows that you just entered the trade and it closes as a red bearish engulfing pattern. The next thing you know, the market starts reversing against you and you're sitting in the red, right? Your account is in the red. And you're wondering, what the just happened, right? So that's the thing, right? Don't chase the markets, because usually when you chase the market, usually when you feel that this is the best time to enter the market, if not I'll miss out the next wave of the move, that's usually the worst time to enter the market, because that's when the market is ready to make a pullback, or even worse, make a full-blown reversal. So usually when your heart, right, tells you, Rayner, it's time to enter, it's time to buy. Nope, it's not a good time to buy. It's better to sit on your hands and do nothing, right? So whenever you have that thought coming in, sit on your hands, evaluate, ask yourself, am I trading near an area of value, right? Is there a logical place for me to set my stop loss? If the answer is no, and no, then don't place the trade. Okay, so that's habit number one, chasing the market. Bad habit number two, right? Fixed position size. So this happens to a lot of new traders, right? They're lazy to learn the math about trading. So whenever they put on a trade, they just go with a fixed lot size. One lot, that's easy, just number one. One lot. Unknowingly, right? One lot equals to 100,000 units in FX market. So for example, if you are having a 10 pip stop loss on euro dollar, one lot, right? It's about a stop loss of $100. So if it hits your 10 pip stop loss, that's a loss of about $100, something that probably most of you can deal with. But when you trade, let's say, a higher time frame, or your stop loss gets wider and you still use that same one lot, that same fixed position size, what's going to happen now is that your losses, right, will increase accordingly. If you have a 50 pip stop loss on the one standard trading lot on euro dollar, that's a potential loss of $500. And if you have a 200 pip stop loss, that's a potential loss of $2,000. So here's the deal, right? You can't be using fixed lot every single time when your size, when your distance of your stop loss is always, changing, right? Because it depends a lot on the time frame that you're trading and the size of your stop loss. So you have to adjust your position size such that every time you put on a trade, right, and even if it's a loss, right, that loss is always consistently a fixed percent of your account, let's say 1% or 2%, right? So you must use a position size that can adjust accordingly to the size of your stop loss, right? Don't use a fixed position size, because what's going to happen is that whenever the size of your stop loss change, your losses is going to change, the amount is going to change. And when the size of your losses amounts change, you're not going to have a consistent results, because sometimes you lose small, sometimes you lose big, sometimes you lose what the just happened, right? So you have to be consistent with your losses, right? Make sure that it's always a fraction of your trading account. And to accomplish that, your position size must be dynamic. It has to shift, all right, according to the size of your stop loss. Number three, no plan for exit, no trading plan. So what do I mean by this is that you have a setup, you enter a trade, maybe it's a fundamental news, a tip, a rumor, whatsoever, you buy. And then you just don't have a plan, right? You just buy and hope that the price goes up, right? And let's say maybe the price really does go up, right? And then someone, a friend like yours, like Rayner, say, hey, Mike, when do you plan to sell that position? And you'll say, right,
I plan to sell when the market has gone up enough, when it has given me enough profits.
Well, guess what? You won't sell when the market has moved in your favor. Trust me on that, right? I have experienced that so many times myself. When the market goes up, you will think it will go up even higher. So you won't sell, right? Because the profits, right, on your screen is so green, right? Why do you want to sell and just take a small gain, right, when the market could move up even higher? So you hold on to that trade. And when do you sell? I'll tell you when you sell, because I have done it so many times myself in the past. You will only sell when the market goes against you, when your profits get smaller and smaller and it turns into red. And when it's red, you can't take it anymore, you exit the trade for a loss, and that's when you will sell. Okay, so my point being here is that you must have a plan, right? Before the moment you enter a trade, you must know when you're going to get out of the trade, if the market moves in your favor or even when it moves against you. If you don't have that plan, you have no business putting on that trade, because you will only sell at the worst possible moment when it's against you, right? Selling near the lows, right? Just when the market is about to, rebound higher. Okay, so don't make that mistake, right? break this habit, right? You must have a plan. Don't trade without a plan. Number 4, bad habit number 4 is this: adjusting your stop loss. So you might have a plan, right? You have a stop loss in place, but whenever the market, seems to know where your stop loss is, all right?
Man, how do you know where my stop loss is?
Right, so you put your stop loss there, and as the market approaches your stop loss, right, you don't want to get stopped out. You don't want to book another loss because you have, suffered 3 losses in a row. So what do? Well, you shift your stop loss, right? You let me shift it down lower, right, so the market doesn't trigger my stop loss, so I can avoid getting stopped out. Well, guess what? Yes, you do avoid getting stopped out. But if the market now moves further against you, that loss is now amplified. It's even a bigger loss, right, than what you had planned earlier. And that kind of defeat the purpose again, right, of me saying earlier, right, to contain your losses, right? Because when you adjust your stop loss, when you shift your stop loss against you, the loss that you have planned ahead of time, right, has now increased in size. So if the market now hits your so-called new stop loss level, your losses has amplified, has increased. And if your losses are not constant, if your losses are not controlled, right, then what's going to happen is that it's going to make it difficult for you to be a profitable trader because, sometimes your losses are big, sometimes it's small, and it's hard to get consistency in your trading, okay? And last one, 5th one, right, is this: itchy fingers, right, wanting action from the market.
Oh man, I want to trade the markets right now. So let me fire up the charts. Let me look through the markets. Let me look through the time frame and find some trading opportunity. Right? Let me find some excitement. Right? Like, where is the money right now?
All right. So here's the thing, right? If you are looking for action, if you have itchy fingers, what you're gonna do is you will simply enter trades based on your emotions, based on what you are seeing at that point in time, and based on how you're feeling at that point in time. And what's gonna happen is that every time when you open up a chart, when you flick through the chart, the different time frames, you will be having different feelings, different emotions, and your actions will be different every single time. One moment you trade breakouts, one moment it's a pullback, one moment it's a reversal trade. And what's going to happen in the grand scheme of things is that your actions are inconsistent, and when you have an inconsistent set of actions, what happens? You get an inconsistent set of results. All right, and this again, right, will hurt your trading, right, in the long run. Okay, so be aware of all these trading habits, right, that actually hurts you more than you think. So quick recap: number 1, don't chase the markets. Number 2, don't use a fixed position size. Number 3, don't trade without a plan. Number 4, don't keep, adjusting your stop loss, right, further and further against you because you don't want to take a loss. And number 5, avoid itchy fingers. Stop looking for action in the markets, right? If the trade is there, it's there. If it isn't, sit on your hands. Okay, so with that said, I wish you good luck, good trading. I will talk to you soon.